Netflix succeed is because they were an innovator in taking market share.
Yeah.
Right. And so there is a raft of companies that we don't want to talk about that are basically dead as a function of Netflix.
Yes.
Right. And so
or had to change their business model.
to radically change their business model, et cetera.
So throw Disney, Warner Brothers.
Yeah, exactly.
Put all those in that pile.
All of those in that pile, and not to mention all the cable companies, which aren't necessarily all public. But if you could, that's a wealth shift within the economy, away from laggards into innovators, right? The world.
But the net benefit to the S&P is undeniable.
For sure.
So you had 5 companies, 10 companies threatened with extinction by Netflix, and then some of them decided to join it because they couldn't beat it. But the net effect for the S&P 500, higher multiple, higher price. So it's a net, even though it's one company taking away from other companies, for the investor class, a net positive. I don't think those companies lost as much market cap as Netflix gained, is what I'm saying.
Yeah, that's true. And the question is, how long can that continue, and how much can essentially the S&P 500 gobble up, the world's market share? And of course, they're picking up market share on a global basis, et cetera. And so, I think there's circumstances like this that I agree with you that traditional value metrics are not necessarily good indications of high market share grabbing companies.
Yeah.
In fact, they're quite bad indicators of high market share.
They're not designed to capture that,
because they're designed to they were designed like in the 50s.
Yeah.
When we had a static set of companies out there. And so they're not good indicators of what's going on. The question is, at the aggregate level, do you start to build up from the bottoms up to a set of aggregate assumptions that make sense or don't make sense? Right.
Okay.
And that's why I think why I draw on in the Mag 7 or you could say the expectations of some of these high flying tech stocks actually seem pretty reasonable, plausible.
Yeah.
But the question is that going to extend to every company in the S&P 500? No. Right. But that's what's being priced in, is that it is going to extend to every company.
You think the median valuation for S&P companies is pricing that sort of enthusiasm in?
That type of earnings growth expectation. Remember, what you see, first of all, the median, we don't have a chart here, but if you look at the median S&P 500 valuation, it's still pretty elevated, right? It's not as elevated as
it's what, like 17,
the market
18?
cap. Yeah.
It's not 22, but it's not 14.
But it's not 14. And that median valuation is typically lower than the market cap PE. And you look at that, and that's on earnings growth expectations for 12-month earnings growth expectations that are extremely elevated. And people look at 12-month forward PE charts and they take 12-month forward earnings as if it's true. And 12-month forward earnings is not true, right? Those are expected earnings. Expected earnings are not real earnings.
That always comes down over time.
They come lower.
Right. And so the reality is that's something like, a high level for the median company for a set of earnings growth that is already expected to be extremely elevated.